Hello, everybody, and welcome back to another airing of Grievances. I'm Eric Reamer, and as you can tell, Rob Grieve is not here today. Instead, he is in Kansas City and presenting to 5 different associations, collision associations, talking about post-repair inspections. We'll get a report from him next week, but for this particular one, I wanted to share with you a refresh, an update on something that Dave LaChance wrote about a month ago in Repair Driven News, and then he's given us an update on it. And we're talking about the Allstate pursuing auto insurance rate increases in a bid to return to profitability. If you haven't yet discovered the value of Repair Driven News, here's a link right here. I'll put it in the comments below as well. I'd love for you to go check them out. They do a great job. Dave does a great job, also Laura and others. But I wanted to point this one out here. Allstate continues to raise rates in response to increased loss ratios, company executives said during a special investor conference focused on auto insurance. Now, this is nothing new. We found this out about, like I said, a month ago, and they cited their interest in getting permission to raise rates. And it says here, since the fourth quarter of 2021, the carriers received approval for 41 rate increases, averaging 7.8% each across 3 different locations. And now think about this for just a minute. They've been approved for 41 rate increases. Now that affects you. That affects me. Now, it doesn't affect me because I don't have Allstate, but if you, the driving public, and by the way, Allstate is not the only insurer that is being affected by these things. We're going to break down why it is they feel like they need to increase their rates and get back to profitability. And again, here at the Airing of Grievances, we do not have a problem with somebody saying we want to be profitable. That's part of the whole business model that we support. I think that's an important thing. But 41 rate increases averaging 7.8% each is significant. So it says here the increases of the past 5 months will bring in an additional $1.2 billion, that's billion with a B, in premiums over the course of the year. And that's according to Glenn Shapiro, who's the president of Allstate's personal lines. Mark Rizzo, the executive vice president, I should say, and chief financial officer, said that Allstate has begun providing monthly reports, I'm not sure to whom, he didn't indicate to whom, on its auto insurance rates and will continue doing so through 2022 as we address rising loss costs. So what's causing what's really driving these the need for these rate increases? Well, we've talked about this a number of times on the channels, and I'll even put a link up here to where you're going to find that information. But ultimately, it's severity. It's we're at a low. We're below 2019 number of accidents, but the accidents that we are having are more severe. People are driving faster, more recklessly, and causing more damage to the vehicles post-pandemic. And because of that, there is a huge increase in the expense for repair. And what they're doing with that, it says here, and just to back that up, it says Allstate saw strong profitability in 2020 and early 21. That was during the pandemic, and of course they saw strong profitability because no one was driving, and because of that, they didn't have to. Your premiums didn't go down, so they saw strong profitability because they didn't have to pay out for all the accidents that people weren't having. However, that changed in the second half of 2021, driven by inflationary pressure on severity, as I've just mentioned. To put that in perspective, they generated auto insurance underwriting income of $1.7 billion during the first half of 2021 and an underwriting loss of $459 million in the second half of the year. So they saw a loss by a third of the profitability. All told, they're still profitable for the year, but nobody's talking about that. Loss ratio, Shapiro said, rose 8 points between the third quarter of 2019 and the third quarter of 2021. The increase in cost being not driven by frequency, but by severity. Physical damage remained below the 2019 levels by 13.3%. That's a huge drop in physical damage, but the damage that is happening is far more expensive. Okay? Interestingly enough, Eric Brandt, who's the Executive Vice President and Chief Claims Officer, says the increase in physical damage severity has added 6 points to the company's loss ratio of 2019. Now, I want you to be aware of some of the words that we're using here. Loss ratio, okay? That's the ratio that is established by the insurer as to what is acceptable in order to maintain the margins. We're going to talk about margins here in a minute. But that's the ratio that the insurer says we're comfortable with this loss ratio, right? So that we maintain the margins, the profitability that keeps everybody paid, and as you know from the insurance industry, paid very, very well. All right, so he says one of the drivers, 68% rise in the value of used cars since 2018. We have also talked about this here on the channel. The value of used cars is going up. What they don't address real well, let's see, it says higher speed accidents have resulted in severe impacts, placing more cars in total loss category, which contributes to about 20% of the increase in the physical damage severity. Interesting. Well, we also made a video about total loss and how sometimes insurers are now taking the standard total loss, which sometimes is 70, 80, or 90% of the car's value. If the repair costs more than that, they will deem it a total loss and then send it off to the auction or to be parted out. But now, these days, cars are being totaled, get this, at a much less percentage of the actual cash value of the car. We mentioned 40 or 50% in a video that we made earlier, and there are rumors that that's even being conservative in our estimates. So yeah, they're being totaled much less, and in so doing, they're being resold to those re-repair folks who can take a car out of a salvage title by re-repairing it and reselling it at near retail rates. So what you've got here is a very serious situation where the insurer is saying, hey, we need to raise your rates. We need to raise your rates in order to get our profitability back up, but we're going to drop the ratio of what it takes to total a car. We'll sell that car to salvage, and then the re-repairers repair it and then sell it again. And all of a sudden you see that nobody's losing a whole lot of money here. We're actually just trying to make sure we don't cut too deeply into our profits. Okay? And again, I don't want you to think that we're saying that making money is bad. We're not. That's clearly not what we're saying. But I do want to report to you that if you're with Allstate or several of the other larger carriers, your rates may and probably are going up because of these issues. And this is the thing that they do. It says here, third and fourth quarters of 21, the states were combined, where the combined ratio was 100 or higher, represent 55% of all states' written premiums. We anticipate our comprehensive approach, including rates, will restore auto profitability to target levels, and I include on our backs, because we're the ones paying the premiums for this. And a little bit more, Brandt goes on to say a little more here. Companies' data scientists had used proprietary data to improve the total loss predictability at first notice of loss by more than 200% of the past year. We did a video on first notice of loss and why the insurer is so determined to make sure that they get notified first when there's been an accident. And it's a huge, I mean, it means everything. They just said that their data scientists are improving total loss predictability by 200% at the moment of the impact. Interesting. The company has seen greater customer adoption of its digital claims tools, such as photo-driven virtual estimating and virtual assist, says the representative of Allstate, a technology that lets body shops video chat with adjusters in real time. Those tools have led to a 1.2 point reduction in the claim expense ratio since 2018, generating a savings of $500 million, which sounds kind of like that $497 million that they were talking about as a loss in the second half of 2021. All this to say this. What they're going to try to do is reduce their expenses. The way that the insurers do that is they make sure that you go to the repair facilities that are on their list. We say if there is a shop on the preferred list of your insurer, that's probably not the shop that you want to go to. If they have what's called a DRP relationship or partnership with the insurer, then they are not looking out for your best interest. Instead, they are looking out for the bottom line of the insurer, who will no doubt make sure that they use aftermarket or salvage parts on your vehicle to cut expenses at every opportunity. So there you have it, guys. I mean, it's not new news, but it is reinforced. I didn't realize there were 41 rate hikes over the course of the last quarter of 2021. 41 of them approved by the government, and now Allstate is implementing that, and they're strapping a saddle on it, and they're going to ride it all the way to the bank at our expense. Want you to be sure that you tune in here again if it's Saturday morning at 9:30 a.m. Make sure you join Rob and I next week. And if it's at that time, you can actually chat with us live during the premiere of these videos. I sure appreciate you for tuning in. Give the video a thumbs up if you would, please. That lets YouTube know that we're doing a good job and shares this content with more people. And if you have any questions at all about the whole process by which insurers and body shops communicate and dynamically work together, don't hesitate to give us a call. Here's our phone number right here, and we'd love to chat with you and let you know that we're here to help in any way, shape, or form. All right, that's going to do it for me. Happy Saturday to you. I sure appreciate you for tuning in. We'll see you next week.